Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Tuesday everybody. In a sign of anxious investors, shell-shocked after months of unpleasant surprises in the Chinese technology sector, today, Tuesday, shares in e-commerce giant Alibaba saw wild swings involving tens of billions of dollars on the Hong Kong exchange after markets feared that Alibaba's founder, Jack Ma, was once again in trouble with the authorities. In Hong Kong today, Alibaba plunged as much as 9.4%, raising about $26 billion of market value after state media reported that authorities in Hangzhou, where Alibaba is based, had imposed sanctions on a person with the same surname as Jack Ma. The losses were then quickly reversed after a statement from local Hangzhounese police made it clear that the individual involved is not Jack Ma. One analyst at Forsyth Bar Asia Limited, speaking to Bloomberg, said it right when they observed that this reaction from investors, quote, shows the relatively weak sentiment in the tech space. I think the market is just a bit too sensitive on this. End quote. And Bloomberg's Hong Kong team themselves observed today that the original 2-sentence report in state media, quote, lacked other details but rattled investors already on edge over Beijing's clampdown over every corner of the internet space, which kicked off by targeting Ma. Regulators halted the IPO of Ma's Ant Group Co. before waging a campaign to rein in alleged abuses and excesses by increasingly powerful internet firms. End quote. Meanwhile, in the United States, in an interview at the Milken Institute Global Conference in Los Angeles yesterday, Monday, U.S. Trade Representative Katherine Tai expressed that relief from U.S. tariffs on China is one option under consideration to confront the fastest inflation the U.S. has been facing in decades. Tai, who took up the position as the top U.S. trade rep with the election of U.S. President Joe Biden, said that any tool that the U.S. needs to meet the short-term challenge of inflation should be studied in the context of broader economic policy and must not undermine the medium-term challenge of U.S.-China competition. And this includes the tariffs placed on Chinese goods during the U.S.-China trade war of the Trump administration, expressing, quote, are they on the table or not? All tools are on the table. The question is, what do you do with them? End quote. And speaking of trade and moving from one major player to another, Russian gas giant Gazprom announced yesterday that natural gas exports to China jumped 60% in the first 4 months of this year versus the same period of 2021. This coming as the energy producer also announced that gas sales to non-Commonwealth of Independent States, CIS countries, had dropped over 26% to 50.1 billion cubic meters in the first 4 months of this year, showing the increasing reliance Russia has with the People's Republic of China. The Russian gas was supplied to China via the Power of Siberia pipeline, which began operating in 2019 and should reach its full capacity by 2025. We remember back in February, Russian President Vladimir Putin signed an estimated $117.5 billion oil and gas deal with Beijing just before the Olympics and of course the Russian invasion of Ukraine. This included a contract to supply China with 10 billion cubic meters of gas a year via a new pipeline which would run through the Far East on the Russian side to China's northeast Heilongjiang province. Next up, the Shanghai Lockdown. But just quickly guys, if you're enjoying the content, don't forget to hit the like button, it's a huge help. And for anyone who wants to go the extra mile and really help keep this channel financially sustainable, Patreon, Buy Me a Coffee, and crypto links are in the description below. As always, thank you everybody for the ongoing support. In another disappointing day, really, for the millions of Shanghainese residents in lockdown, today, Tuesday, saw more new official cases discovered outside quarantine zones. And what's worse, the numbers are inching up. The local health commission announced today that 73 cases in the so-called precautionary zones, aka low-risk zones, those zones that have not had an infection in the previous 14 days, had been detected in the previous 48 hours. up from 58 a day earlier. No cases in these so-called low-risk zones had been discovered, officially, over the weekend, a development which sparked hopes that the megacity of 25 million might be turning a corner. Now many, both domestically and overseas, point out that the official numbers are not reliable, but at the very least we can see that there is a negative trend here, and it's a bad sign for the people of Shanghai, and it means that lockdowns will continue to drag on. Quote, rising infections in the unguarded zones prevented local authorities from announcing that Shanghai had achieved the societal zero-COVID goal. End quote. Now, while we're on the Shanghai lockdowns, in a bizarre and frankly quite disturbing development which has sparked a lot of anger online, Chinese domestic media is reporting that 5 district officials in Shanghai are being investigated after a nursing home resident was transferred to a funeral parlor while still alive. In a video which went viral on the Chinese internet on Sunday, a body can be seen being collected from a funeral home car parked at the entrance of a local senior nursing home. In the video, the voice of the witness filming the incident says that funeral home staff had returned the elderly person to the nursing home because they were still alive. The following day, yesterday, on Monday, the Shanghai branch of the Central Commission for Discipline Inspection announced that the Communist Party Secretary and Bureau Chief of the Civil Affairs Bureau of the district in question where the incident took place has been placed under party investigation. On Monday, it was reported too that the elderly gentleman who suffered through this ordeal has been admitted to hospital. While cases are still being discovered in so-called safe zones, after a month of strict lockdown, officially recognized numbers overall are coming down. Today, Tuesday, new cases fell for the 10th straight day, down 22.7% over a day earlier. Symptomatic cases are now at a new low of 274. Many question the accuracy of these numbers, but if official numbers affect loosening policies, then the general trend for Shanghai, at the very least, is positive. We remember, though, that there are dozens of cities across the country fighting their own outbreaks and seeing lockdowns, and Shanghai itself is certainly not out of the woods yet. And finally, let's continue our ongoing examination of the Evergrande Housing Crisis, and we will continue where we left off yesterday when we were discussing the central government backing local government efforts to loosen demand-side restrictions to support the housing market without going so far as to remove the 3 red lines policy which sparked the Evergrande crisis in the first place. Since these policy easing moves are on the household side, let's look at the households first. As we've seen in previous episodes, household confidence has been hit hard, as has household income. A double hit like this is going to make it very difficult to stimulate the demand side and get people buying homes in large enough numbers again. According to the People's Bank of China, new household loans fell 50.8% year-on-year in the first quarter, compared to a 10.3% drop in the previous quarter, which was already a bad sign. This illustrates that Chinese households wish to save more and consume and borrow less. With national lockdowns in place, this is not surprising. That same central bank conducted a survey of 20,000 bank depositors in the first quarter also, which found, among other things, that 54% wanted to save more, the highest figure since surveys began in 2009. Just over 1 in 5 planned to spend more, a bad sign for both demand for housing as well as general consumption across the economy. And these people were not lying. In March, we recall, retail sales dropped 3.5% year-on-year, with analysts expecting greater deteriorations as we move into the second quarter. Analysts point out that another short-term factor likely to weaken the impact of government easing policies is that households believe that the liquidity crisis facing many developers is not over, and indeed will likely continue well into this year. Quote, home buyers feel uncertain about property developers' futures and are also worried that more developers will be unable to finish the housing projects they buy. End quote. There's just one more thing I wanted to cover on the housing sector in today's video. This week, analysts with Chinese financial outlet Caixin argue that even though the property market may recover eventually if they get the right support and if they get pumped back up, especially in the larger cities, there are still three main long-term problems which will remain. Now quoting the Caixin piece, the first issue is that China's overall housing supply is sufficient thanks to decades of construction and the prospect of low birth rates in the coming decades. Quote, according to research by a team led by economist Ran Ziping, the ratio of finished residential units to the number of households rose to 1.09 in 2018 from 0.8 in 1978, implying that supply has reached demand. The total value of China's housing market was 62.6 trillion in 2020, 4.1 times the country's GDP that year, and 86% higher than the United States housing market, he estimated. In smaller cities and the country's inland and northeastern regions, there is a glut of housing supply. About 70% of cities will see a surplus of housing in the future. End quote. Second, there could be less property speculation because of weaker expectations for long-term growth, overturning the decades-old belief that property prices will always rise. And third, while Chinese households were once famous for being savers, now they are facing growing debt problems, with some arguing that China's next major crisis will be Chinese household debt. But that is a topic for another video.